Well, good afternoon and welcome. And again, sorry for the delayed start. My name is Scott Kozak, Director of Learning and Development here at Union Savings Bank, and I will act as the moderator for our webinar this afternoon, which is Dynamic Financial Planning, Your Solution for Success. We have three exceptional speakers that are going to be sharing their knowledge and expertise with you over the next 45 minutes or so. So you're in for a treat. Questions are encouraged, so if you have questions for any of our three speakers as they present, please log those in the chat and we'll field those as we go. One other point of note is that at the end, there'll be a brief 5-question survey. I'll probably take you all 2 or 3 minutes to complete. Your feedback is important to us, so if you wouldn't mind just taking a minute or two and completing that 5-question survey for us, we would be very appreciative of that. So with that, I'm going to go ahead and bring up Chris, one of our first of 3 speakers, to kind of introduce himself and then kick things off to the other 3 speakers. So thanks again for your patience.
Yeah, thanks, Scott. And again, thank you all. Appreciate the patience there. So my name is Chris Cavello. I am the Senior Financial Planner here over at Union Savings Bank in our Wealth Management Department. I'm a CFP, as you can see there from the screen, a Certified Financial Planner. I've been in the financial services industry for approximately 15 years. Big passion for financial planning and working with the clients, both small and large. So really excited to be able to share that passion with you today and cover some detailed financial planning strategies. Brandon?
Great. Thanks, Chris. And thank you to everyone for joining today and also for your patience as we got started here. My name is Brandon Angadi. I'm a certified financial planner with Union Savings Bank. I've been here for about 4.5 years now. Previously, I held roles as an auditor at Deloitte in Stanford, as well as a fund accountant and operations associate at a hedge fund private equity fund in Greenwich. I really enjoy working with individuals and families to accomplish their goals and achieve financial independence. We use a pretty powerful financial planning software tool that allows us to build and run future scenarios to quantify clients' goals and alleviate or solve their financial concerns. And when working with clients, we focus on their full financial picture, including all assets and liabilities, whether at the bank or not, income streams and expenses, insurance coverage, and family affairs, which usually leads to an estate planning conversation with our third presenter today, Rosalie Graysick. I'm looking forward to our webinar today, and I hope you all enjoy it. Rosalie?
Thank you, Brandon. Good afternoon, everyone. I'm Rosalie Graysick. I'm a Senior Trust Officer and Fiduciary Advisor. I've been with the bank about 5 years. Prior to joining Union, I was an estate and trust paralegal for a large law firm in Hartford and worked as a Senior Trust Officer and Portfolio Manager for BNY Mellon and for Key Bank. I enjoy helping families put together a good estate plan. I also administer trusts of various sizes, and also I assist in the estate settlement process for Union Savings Bank, working with clients that are going through a very emotional time. Having said that, I'll move it back over to Scott.
Actually, Rose, I'll jump in here and get the ball rolling. So before we actually jump into specific financial planning strategies, I think it's actually very important for us to highlight the planning process itself. And so holistic financial planning actually begins with a very comprehensive lens. Although the advice we provide is going to be tailored to your specific goals, we would actually be doing you a disservice if we didn't take a look at all the aspects of the socio and economic environment when performing that analysis. So as you guys can see here, the planning process is designed to build upon itself in incremental steps. This allows us to create a relationship with our clients that is really about more than the numbers. It's about helping our clients achieve their unique goals by providing specific, customized solutions that are going to take these big, complex scenarios and turn them into simplified, actionable advice. Our conversation will cover your full financial picture, including all your assets, both managed by Union Savings Bank and external, liabilities, income streams, expenses, insurance, and especially your family situation. In doing this, we can actually gather a clear picture of your full financial world, and that allows us to give better, more accurate advice. The comprehensive lens can then be narrowed at that point to identify how your individual needs are impacted by this analysis. So, for example, if we determine that a 60-40 balanced portfolio is appropriate for a USB IRA based on your risk tolerance and your risk capacity, if we didn't consider your 401k allocation in that equation, the overall investment risk could be skewed significantly. So each recommendation takes your full financial situation into account and actually considers the impact on all areas of your finances. Financial planning should be viewed as a verb rather than a noun, given that it's an ongoing process. We produce a summary of advice after our initial planning sessions, just so you have something to use as a guide for implementation. But the value of financial planning comes from that process itself and the dialogue that we create together. And we could jump ahead here, Scott, in the next slide. Now, it's also important to highlight that financial planning is not just for your personal goals. For small business owners or individuals with closely held business entities, we offer business planning services in conjunction with the personal plan. For these individuals, their business is often the largest asset that they have and a critical part of their individual retirement picture. So many of the strategies we recommend on the personal side rely on preserving the value of that entity through time. So this means that extra attention needs to be placed on the business's health and growth goals. Specifically, succession planning allows a business owner to feel a little bit more comfortable that the business will continue in the event that they're no longer able to contribute to it. So we'll work to ensure that you have sufficient plan in place to address things like death, disability, divorce, and any number of other various legal entanglements like disbarment, lawsuits, etc. A business will also give its owner an advantage when it comes to retirement savings. So we work with the owner to determine if a retirement plan can be established and which type based on their individual retirement savings needs. And this will also directly connect with the possible needs to provide retirement savings benefits to employees of the business or to find ways to incentivize key employees to stay. And finally, when owners are ready to exit their business and they'd like to ensure that there's a smooth transition to that next owner, we will help to establish a proper timeline and ensure that the right resources are used to preserve the value of that business, which again, might be critical to that exiting owner's retirement needs. And as with personal planning, if one of the solutions we've identified is something that we can help to implement internally, we will actually walk you through the best resources to accomplish those necessary steps. And this often includes coordinating with attorneys, CPAs, et cetera. But let's jump into our first polling question here. And Scott, you're working on getting that popped up.
Yep, I'm going to go ahead and add our first poll. So you should see it launch on your screen. And if you wouldn't mind, just go ahead and answering this question. We'll leave it open for about 30 seconds or so, give everyone a chance to participate if you'd like to.
Yeah, and this question does a great job of just giving us a sense of everybody's experience with planning in the past and how that experience went, which is again unique to everyone.
Excellent. Looks like we're a little over 60%. We'll leave it open for another 10 seconds or so to get a nice sampling.
Perfect. And looks like we're trending to no, but I have thought about it. And that's a very common theme that we see with many of the clients that we work with here.
Perfect. Looks like we inched over 75%.
Beautiful. Yeah. Again, it seems the results are skewing in one direction. So I think that's a great takeaway. And hopefully, our discussions here on the process will make you feel a little bit more comfortable about jumping into that in the future there.
There we go. I just shared the results with everyone so they can see.
Perfect. All right. So let's jump ahead. I know we're still making up some time here, right? All right. So, the next thing we're going to cover here is working through what goals and values actually look like within a financial plan. So as we talked about earlier, our priority with the financial planning team here is to work together with our clients to create that true partnership. We know there are financial calculators out there that can help you to determine a number, but our partnership gives you the ability to not only analyze the quantitative side of life, but also ensure that your goals and actions align with the qualitative side of your life. Your personal values. So the first step is going to be identifying goals. As we discussed earlier, we specialize in taking complex financial planning scenarios and creating those simplified, actionable solutions. And more importantly, follow up with you to ensure that you're able to implement those solutions successfully and efficiently. In addition, we have no proprietary products here. So implementation of advice is actually done by determining what is truly the best fit for each individual. Our next step is going to be creating accountability. So we actually work as an accountability partner here within the financial planning relationship to keep you organized and on track no matter where we find the solution. So in many cases, this is us acting as the quarterback of your financial team, helping you to connect your attorney, your accountant, your insurance agents, all into that one team built to help you succeed. So we help you organize your financial life and provide you with an objective point of view. And we'll help you to look ahead and better prepare for and manage those life transitions that always pop up, and educate yourself on and helping make good decisions. Finally, our advice is ongoing. Most importantly, we define our success through the eyes of our clients. And we work to ensure that, we are not only providing solutions, but a trusted relationship to ensure that those solutions you implement remain appropriate through time. How often we meet, that's determined based on your comfort level. It can be done annually, semi-annually, quarterly. As we all know, based on the last few years, the world is a volatile place, and we want our clients to know that we are there to help them sort through the unpredictable, no matter how and where that occurs. Lastly here, before we jump into some scenarios as a planning highlight, I think it's important that we take a moment to discuss goal development. So the financial planning process is designed to help you identify your financial goals. This is often defined, again, as the quantitative side. However, just as important is using financial planning to identify your personal values, both individually and as a couple where applicable. And again, this is the qualitative side of financial planning, and it is our job as accountability partners to help you not only identify these values, but diagnose your specific actions to ensure that they work towards the protection of those values. Let's break each one down separately, though. When starting a financial goal, it's important that they be defined using SMART criteria. And just looking at the slide screen here, we may want to jump ahead, Scott. I think the slides are a little bit behind. There we go. So let's break down what SMART actually stands for. Specific. First and foremost, goals should be focused and identify a very tangible outcome. Being more specific will help us be more accurate when measuring success and identifying solutions and resources to leverage. They should be measurable as well. We ask that you ask yourself how much or how many when measuring your goal, because this expected result will allow us to more clearly define the actions you need to take now. For example, specific saving amount, specific budget adjustment. The goals should also be attainable. They should be challenging to an extent, but should also be within the realm of possibility. So we tend to lean a little bit more conservative with our assumptions in a financial plan to provide that stronger analysis. And an unattainable goal will actually put undue stress on your resources. A goal should be relevant, and this directly ties to your personal values. Your goals should align with what's most important to you. And finally, the goal should be time-bound. It's very important to ask yourself when. This should really also follow the attainable rule. Timelines should be realistic, but they should also always be flexible. The best goals are those with moving targets that can be adjusted to adapt to the changing world. So let's look at an example of how this works in reality. Instead of stating, I'd like to make sure I can retire, we want to work to build something smart. So in this example, we would say, I'd like to make sure that I can retire at age 62, living at roughly 80% of my current income level, and maybe adding in an additional $15,000 a year just dedicated for travel. So as we discussed earlier, at the heart of your financial goals are your personal values. There are many different exercises out there to help you identify your own personal values, but once you do, a financial planning partnership will help to ensure that your goals and actions are aligned to these values. For example, let's say that your three values are wealth, family, and security. A financial goal to purchase a boat in 3 years, or maybe the action of increasing your discretionary spending rather than your savings, likely doesn't align with these values. Planning will help you identify that and make the necessary adjustments. Brandon, now that we've actually covered why the planning relationship is important, what are some specific strategies that you work on with your clients?
Yeah, thanks, Chris. So now that we've covered, holistic financial planning sort of as a whole, we can spend a little bit of time discussing retirement planning and the associated goals and needs for our clients. Dynamic financial planning requires involvement of the certainty of uncertainty driven by the critical variables that we have listed here. When we analyze our goals, we predict and define future needs, such as needing a certain amount of income for certain lifestyle expenses. It's not quite as simple as multiplying your asset base by 4% and using that. To best address, we need to take it a step further with the creation of a dynamic and flexible financial plan. We've already seen major changes to tax rates and estate laws through the Tax Cuts and Jobs Act, the Secure Act, and the Secure Act 2.0. Medical expenses and long-term care costs are continuing to skyrocket and are a critical piece of any dynamic and comprehensive financial plan. And finally, legacy needs are also constantly evolving as laws change and client family situations change. By incorporating these variables into our financial plans, we can provide a better roadmap through the retirement of our clients. So with that, before we continue into some further slides, we're going to go ahead and do another polling question here.
Okay, let me go ahead and cue that up. And you should see it. All right, responses are starting to flow in. We'll leave it open for another 30 seconds to get a nice sampling. If you haven't already done so, please go ahead and respond to our polling question, please. All right, looks like we have just over 70% of the folks on the webinar have participated already. So I'm going to go ahead, it's a pretty nice sampling. Go ahead and end poll and share results with all of you. And here you are. Outliving your money, 58%. Go ahead and stop share. Turn it back over to Brandon.
So as we continue our conversation into retirement spending and saving for retirement, we can look at what's referred to as the tax control triangle. So everyone has heard the saying, it's important to diversify your assets in the context of asset allocation. But the concept of asset location is much less well known and is arguably just as important. So we'll explore it a little bit here. When looking at your retirement savings, it's important to use the 3 different buckets that we have listed here. So your tax deferred is going to be your traditional IRAs, 401ks, 403bs, and tax deductible SEP contributions. We're going to also want to sprinkle in and make sure we have representation from a taxable bucket, which will be your bank accounts, general investment brokerage accounts, your real estate. And then finally, the third piece is going to be having that tax-free bucket. So your Roth IRAs, cash value life insurance, health savings account, and there is even now a Roth SEP that's been made available to clients. So, we can look at, 2 separate clients that both want to generate, $100,000 per year in income in retirement. So the first client is going to be, very overweight just in the qualified assets. So they spent their entire careers, sort of getting that tax deduction, loading up their 401ks and their IRAs, and didn't necessarily pay attention to the other 2 buckets. So in this situation, if they wanted to pull 100 grand, they would need to pull it almost all from their 401k IRA, assuming, state and federal income taxes combined, they'd be, 25% tax rate. So they're going to pay $25,000 in taxes, and there's no funds that are being pulled from their taxable account or, tax-free income from their Roth buckets. On the other side of the coin, we can work with a client that has, sort of a diversified net worth where they're going to pull $50,000 from their tax deferred buckets. So they'll pay, $12,500 in taxes. They're going to pull $25,000 from their taxable account at a 15% tax rate. So that'll be their dividends and that'll be their long-term capital gains. And that'll generate $3,750 in taxes. And then finally, they can pull $25,000 from their Roth accounts. So even though both accounts generated, $100,000 of income, the taxes being paid with a diversified net worth are substantially lower at $16,250. The other times that we see this really come into consideration is in really 2 different ways, where one is a client wants to retire early prior to 59 and a half, or their health does not allow them to continue working to their 60s and they're almost forced to retire in their 50s. In these circumstances, it is important to have the taxable and tax-free buckets so you can sort of have that bridge to when you're 59 and a half or when you're 62, 65, 67, 70, when you start taking your Social Security. So that's where this really comes in, to have that money that you can access without penalty prior to that 59 and a half age attainment. The other place this comes into consideration is, if someone were to retire in their early 60s, they're the older of the two spouses and the higher earner, where it really makes the most sense for them to delay Social Security until 70. During that time frame, they'll be in a very low tax bracket, and they'll be able to start doing some Roth conversions during that time period, prior to Social Security income coming in and prior to those required minimum distributions coming through. So, no one can really predict the future, but we do know right now, tax rates are, on the lower side and may increase, when the Tax Cuts and Jobs Act sunsets at the end of 2025. But we can use historical data to best, find ways to draw assets for you in retirement. So, it's very important that we fill all three of these buckets. There's no magical formula for a third, a third, a third. Everyone's situation varies, but it's important to make sure that all three buckets are represented to give you the most flexibility in retirement. So we'll talk about next is also, funds coming out. So distribution when you're in retirement, and then also how things work upon inheritance if you were to pass, when the money flows down to your heirs. And we do get this question a lot in terms of, gifting, should I gift my home to my children? Should I gift assets? So we can sort of cover that a little bit here. So, while you're alive and when you're in your 60s, 70s, 80s, you're pulling funds out from these different buckets that we discussed. Any sort of qualified accounts, those 401ks, IRAs, SEP accounts, those are going to be taxed at ordinary income rates. So every dollar you pull out is going to be fully taxable. On your taxable accounts, if there are dividends generated or long-term capital gains, those will be taxed at the capital gains rates, which are 0, 15, or 20%, depending on how much money you make. Also, if you have any short-term capital gains, or you have interest earned on bonds or money markets, or dividends paid on non-qualified international stock, that'll be taxed at ordinary income tax rates within your taxable account. And then on the tax advantage side, so your Roth IRAs, your Roth SEP, those, it'll be fully tax-free when you pull that out. In terms of on the inheritance side, if someone were to inherit a 401k or an IRA, it is taxable to the beneficiary at ordinary income tax rates over a 10-year period. The stretch IRA has been eliminated, so you do need to empty the account within 10 years. You don't need to spend it, but you do need to pull the funds out and pay taxes on it because the IRS wants their money back. There are a few specific instances for eligible beneficiaries that are not subject to this 10% rule, but that's sort of beyond the scope of our discussion today. On the taxable account side, there's what's referred to as a step up in basis for the beneficiary. So if you were to purchase Apple stock, you have $1 million worth, your basis in it is $200,000. If you were to sell it while living, you would have an $800,000 gain, the difference between the basis and the market value. If your children inherited, their basis gets stepped up to the market value. So they could sell the full $1 million completely tax-free. And that gets back to the question of, should I gift it or should I wait until I pass away? In most instances, it does make more sense. The same works for real estate. If your home, you bought it for $200,000, now it's worth $1 million. That same capital gain can be avoided if the funds are inherited. So that's something that we take into consideration for all these conversations as well. And then finally, for your tax advantage accounts, the IRAs, the Roth SEPs, upon inheritance, they do have a similar 10-year rule where the funds need to be depleted, but the beneficiaries don't pay any taxes on that. So there's actually a pretty good opportunity there for some tax planning and some inheritance planning. The next piece we'll talk about is health insurance planning. So you want to make sure that you're sort of covered by the proper plan given your circumstances, your age, your health. And one of the most, one of the best ways to do that is to really dive in and understand, what the best coverage for you and your family are. But for individuals where they're young, they're healthy, or they just don't have a lot of medical expenses every year, a great retirement opportunity that's extremely underutilized is using a health savings account when associated with a high deductible health insurance plan. And the way it works is essentially it has a triple tax advantage. So it's arguably better than IRA or Roth IRA because those are only double tax advantage, where this is triple. So the three come in where you get a tax deduction when you put money in. The money grows tax-free in the account. And then when you pull the money out, if it's used for qualified medical expenses, it comes out completely tax-free. So you have sort of all three of those tax advantages, whereas on a Roth or a traditional IRA, you pay taxes on one of the two ends. And finally, if the funds are not used for medical expenses, once you turn 65, funds can be taken out but it will be taxable as if it is similar to what an IRA would treat it. So within these accounts, another big benefit is you're required to keep $1,000 to $2,000 in cash just for expenses if we were to use it. However, the remainder can be invested in mutual funds, just like your 401k. There's an investment selection where you can go in and choose some of those. And what we'll do with a lot of clients, especially if they have sufficient cash flow, is actually encourage them to pay medical expenses out of pocket and just sort of leave this money alone and treat it like an IRA and just allow these funds to grow and grow and grow and compound. So it's really, like I said, a really nice opportunity to get some additional funds set aside. And also, given, retirement today and the way medical expenses are trending, a 65-year-old couple could expect, several $100,000 of medical expenses out of pocket during their lifetime, assuming they have Medicare Parts A, B, and D. So we want to make sure that, we're also reviewing the client's health insurance needs and taking advantage of this great account, which is the health savings account. So with that, I'll turn that back over to Chris to talk about some insurance options.
Yeah, thanks, Brendan. We've talked a lot about how important tax diversity is to creating flexibility in your financial plan. Because of that, I did just want to take a quick moment to highlight one of the more dynamic assets that it's available to achieve it. Permanent cash value life insurance policies, specifically whole life, which is you see here in the slide. Although it's expensive to get into, especially later in life, permanent insurance can actually optimize the risk-reward profile of an investment portfolio. It's a uniquely qualified asset in that the cash value of the policy accumulates tax-deferred, but then has the ability to produce a significant amount of tax-free income when it's needed the most. This is because policies can be designed specifically to meet your individual needs. So although the death benefit is usually the primary driver to acquiring the policy, a financial planner can actually help to identify how that policy can be molded and constructed to fit your needs and remain in force while still providing income. Furthermore, this type of policy is usually uncorrelated to the market. So that's very important in a situation where there's a large downturn in the economy or in the financial markets at a very critical time in your life when you may need income. You can actually choose to use the policy to provide that income while letting your other assets rebound. So great tool. We can spend a lot of time on this, but I did just want to highlight it as one of the valuable resources out there. Next up here, much of what we've discussed today regarding foundational strategies, they can help someone in the prime of their working years, what we would call an accumulator, feel more comfortable. However, retirement planning is not just about where to save in those accumulating years. It's also about identifying strategies for individuals entering into their retirement years or addressing the concerns of those that might already be there. These individuals are either already relying upon their assets for income or will likely be doing so in the near future. So if these individuals are unprepared, that certainty of uncertainty we discussed about earlier, that can come as a bit of a shock in certain situations. They might look at their statement and wonder why or how they're able to rebound from a recession given their short-term needs. Many retirees feel like they don't have time to let their assets bounce back from these situations. And that's where financial planning is most valuable. A strong financial plan, a dynamic financial plan, will look to position your assets based on your individual income needs and your individual timeline. So one of the more common strategies for doing this is the retirement income framework, or as many people call it casually, the bucket approach. This strategy works to position your assets into several buckets, each with a specific job. The diagram you see here is actually an example of how this strategy can be used, but it's also really important to keep in mind that this is merely just one example. The benefit of using the framework is that it can be customized to your individual needs. So this includes your risk tolerance, your opinions regarding time horizon, and any other tweaks we need to make. A great example of this could be maybe a more conservative individual might adjust the timelines along the bottom of each bucket. They may put more of an emphasis on the guaranteed income sources, or they may actually eliminate certain asset classes from the buckets entirely. In addition, the number of buckets can actually be adjusted to meet your personal comfort level. So I've worked with several clients that feel that maybe 2 buckets is sufficient to achieve their goals. One with their liquid assets and then the other with general long-term investments. But that being said, let's break down the concept. To begin, it's important that you have a strong understanding of your goals and their respective outflows. So this, you can see it's demonstrated here on the right using the 4 L's: longevity, lifestyle, legacy, and liquidity. It's important to note that this does include breaking down exactly how much is needed for your necessities and how much is needed for your discretionary spending items. Once you've determined your budget, you can determine your annual withdrawal need by subtracting any guaranteed income sources from this total. This amount is the total you'll need to withdraw from the short-term bucket each year. In addition, this strategy can be tweaked so that rather than holding more in the short-term bucket to accommodate those discretionary spending items we mentioned earlier, if you're a budget-conscious individual, you can instead choose to only fund your fixed necessary expenses from that short-term bucket. You would then fund your discretionary expenses from that second income-producing bucket and reduce your discretionary spending in those years where there's poor performance in the market. This means that there would be more in the longer-term buckets for future growth, but also means that you'll have years in retirement where you may need to tighten your belt a little bit. This strategy can also be used by individuals who maybe don't feel confident in the amount of total assets that they have for retirement, wanting to stretch those assets out a little bit further. But at the end of the short bucket timeline, which in our example here is 2 to 3 years, the intermediate bucket will actually replenish the short-term bucket, and the same holds true all the way up. If an emergency should arise where additional funds are needed, they can be taken from the long-term bucket in positive years, and then in down years, you can utilize a non-correlated asset, maybe a cash value policy we talked about, or utilize an efficient source of debt, like a HELOC, for example, and then you just repay that debt when the market rebounds. This retirement income framework strategy, it really is a fantastic way to provide extra peace of mind if you're retired, or it's someone who's quickly approaching their retirement. And really, it's a core part of financial planning. We work with our clients on using this strategy all the time, and we will also run it through several simulations and stress tests to ensure that it provides a high level of confidence. With that, I think we're jumping into our last polling question here.
Excellent. Thank you. We have our final polling question. We go ahead and present that to our audience.
And this one really is designed to just help us get a sense of who we're speaking to today and where you guys are in your planning goals. Hopefully, individuals have started to think about this and are able to identify that bucket.
All right, results are flowing in. We'll see if we can crest over that 70% participation mark. Looks like we're fastly approaching that. So we'll leave it open for another 20 seconds or so for those that want to participate.
Yeah, it looks like we're getting a diversified set of answers here, which is nice. Looks like we slowed down here. So yeah, if we want to share the results.
Perfect. End poll, share results.
Yeah, looks like accumulation is the leader, but we are decently spread amongst the rest. Accumulation years are usually the most important years, but again, I just want to always highlight that financial planning is for everyone. So regardless of where you are in this spectrum, it's always valuable to have these discussions. In the interest of time, we can move on though. I'm going to actually pass this back to Brandon to cover some key timely Roth opportunities.
Thanks, Chris. Yeah, one of the things we wanted to make sure that we covered today was looking into some timely Roth opportunities. I think, one of the things a lot of people are talking about is the end of the Tax Cuts and Jobs Act, which is set to sunset at the end of 2025. So, rates right now are sort of at historic lows, and it seems like, as assuming nothing is done, nothing has changed, and they sort of just let the tax rates sunset, there will be an increase in those tax rates going forward from 2026 on. And also that standard deduction that everyone's been enjoying so much will get cut in half back to the previous levels. So, if you're in the 12% bracket now, you'll probably get bumped to the 15, 22 to 25, and 24 to 28. So, you can do some Roth conversions right now over the next 2 years at lower levels than you would see in the future. And also, if you leave the funds pre-tax, that money will get taxed at a much higher level if you were to not do those Roth conversions. So there's definitely a really nice opportunity to do that there, especially if you're in a few year period where, you're prior to claiming Social Security, it's prior to taking your RMDs, where you're in a very low tax bracket, you can start moving some of those funds over, like I said, at that 12% or 22% tax bracket, which is important. Another great feature that was added to the Secure Act 2.0 was, now you can actually roll over unused 529 college savings plan assets into a Roth. And I get that question a lot, is what if I overfund an account, or, what if my, child ends up not going to college? Every year they're sort of making 529s even more flexible. And this most recent change allows you to roll over $35,000 of unused 529 assets over into a Roth, assuming the funds have been in the plan for at least 15 years. So it's going to be a while before we start seeing these in action, but you can sort of get the process started now. If you have younger children, you can start to shift funds over and not have to worry so much about, overfunding account or losing out on some of the growth. Another piece that's very, a great financial planning tool for children is actually to start a Roth IRA for them as soon as they have a paycheck. Right. So as soon as they have earned income, a W-2, a 1099, they're filing a tax return, they can fund a Roth IRA up to $7,000 for 2024, or as much as they earn. So if they earn $3,000, that's sort of the max that they can put in. But by doing this, there's no tax deduction on it, but they're not going to be in a high tax bracket anyway. So it makes more sense to put it in the Roth. And then we can sort of allow these funds to compound, tax-free for 40, 50, 60 years. And it really, compounds quickly into a larger amount. So a great opportunity to do that with some Roth options. And finally, another piece that was sort of passed through the Secure Act 2.0 is allowing, not only can you do a Roth 401k contributions, but typically, prior to this, the match that you receive from your company could only be received on a pre-tax basis. So when you go into retirement, you end up having to pay tax on that. Now, what they allow you to do is you can actually take those Roth contribution, the employer contributions, as Roth. So you pay taxes on it right now, but then it stays in the Roth account forever. This is a change that was made fairly recently, and there aren't a lot of companies that have adopted this in their plan yet, but it's something that we'll see more and more companies converting over the next few years. And it's something that, savers for retirement should start to utilize and at least take into consideration for their financial plan to make sure they have a good amount of Roth money set aside. So with that, I'll hand it over to Rosalie, our senior trust officer, to talk a little bit about some estate planning strategies.
Thank you, Brandon. So continuing with the thought that the estate tax exemption is going to be cut in half starting in January of 2026. Right now, as it mentions here on the slide, each individual has a $13.61 million exemption for lifetime gifts during their lifetime and also upon their death. So they can pass assets to another generation during their life or at their death up to that amount, and there will be no federal estate tax. With this being cut in half down to about 7 million, I can't emphasize more that between now and that time, it's very important to review your estate plan. It's probably the most important time that I can see over the past several decades. It's very important to take note. And you will have various strategies that you can implement in order to use the exemption now, because it is locked in based on the IRS rule that there is no clawback is the term they use. So right now you can use each individual 13.6 million, spouse 27 million total, move assets out of your estate so that it'll reduce the estate tax at the end when you do pass. Having said that, as part of our estate planning services that the bank offers, the bank can act as your executor, and we can act as your trustee, and we also can act as a co-trustee or co-executor. What we have seen is a lot of times someone will name a family member, for an example, as executor of their estate. And at the end of the day, when the individual passes, that family member doesn't have the time nor the expertise or experience in order to settle an estate. For that reason, we have seen it being very successful with individuals naming Union Savings Bank as the corporate executor of the estate. We settle them from the beginning to the end, right through the distribution to the beneficiaries. And we work closely with the drafting attorney who prepares the will and or the trust agreement. So I did want to mention that. A lot of people are not aware of that. Going into the strategies that they are available to individuals in order to reduce your estate. I think you, Scott, if you don't mind going to the next slide. There are many, many strategies. Each of these topics can be a whole separate webinar in itself. So I'm just going to talk at a very high level, just to make you aware of the various options people have to reduce their estate now while the exemption is high, and freezing asset values also. So just to give you an idea, there are various types of trusts that an individual can establish now. One of them is a spousal lifetime access trust. The icon is a slat. It's an irrevocable transfer into a trust. Now, all of these trusts that I'm going to be referring to are legal documents that are prepared by an attorney. So for the slat, if you will, one spouse donates to the trust, transfers assets for the use of the other spouse for his or her lifetime. And then upon that spouse's death, it passes, for an example, to children. The nice thing about this type of trust is that although one spouse is irrevocably transferring assets to the spouse, they still are going to indirectly receive the benefits of those assets, being that they are the spouse, as long as there's no divorce. But aside from that, it is another option that you can move assets over and still benefit from the assets, and it is removed from your estate for federal estate tax purposes. The Qualified Personal Residence Trust, otherwise known as the QPER, if you have a personal residence or even a second home, and you have a very high net worth value in these properties, you want to move them out of your estate, what you can do is have your attorney draft a QPER trust. It is usually for a certain term of years, and that depends on the individual's age and health. You transfer the real estate title to the trust, and as long as that donor, it survives the term of the trust, it is removed from his or her estate, will pass to their beneficiaries. Now, during the term of the QPER, the individual does receive certain payments from the trust. They are allowed to stay there rent-free. Once the trust term ends, they are going to be required to pay rent or enter into some sort of a lease agreement. But what's nice about it is, again, if you have, let's say, a second home that's worth $1 million, $2 million, what have you, and you want to remove that value from your estate, have your attorney draft a QPER, retitle the house into the trust, and you can remove that asset from your estate and save on estate taxes. The Generation Skipping Trust, the GST trust as it's called, is used in order to transfer assets to skip a generation to individuals, and they do not have to be family, who is 37 and a half years old or more or younger than you are. And in this case, the reason for a generation skipping trust is there is a generation skipping transfer tax, which is right now equal to the 13.6 million. It is a separate tax. So it is important, if individuals are going to be leaving their estate to a second generation, that the proper trust is prepared, and this is a good vehicle to use in that instance because it will save on the generation skipping transfer tax. There's more involved language that goes into the drafting of it, and it's out of the scope of this webinar. The charitable remainder trust is very common, and it's a great vehicle to use if you have charitable intentions. And what this trust does is you're transferring assets to the trust. In turn, the donor is going to receive annual payouts, usually equal to about 5% as an example. So 5% of the value of the assets of the trust will be paid to the donor who is funding that trust. And I won't go any further. There's other options on how to receive the payments, but just for the information for today, you will receive a payment back, which is taxable to you. However, on your death, the assets in that trust will pass to a charity. It is removed, the assets are removed from your estate for federal estate tax purposes, and you also get an immediate income tax deduction once you fund that trust. And there's a calculation that's done and given to the client. So we've seen a lot, we manage a lot of charitable remainder trusts in our department and have a lot of experience with them. The grantor retained annuity trust, otherwise known as the GRAT, this is a trust that is set up for the most part in a low interest rate environment. Why a low interest rate environment is because the goal of this trust is to transfer growth in an asset to your heirs. So you are not transferring, let's say you want to open up a GRAT and you have, let's say, $1 million of a particular stock or a group of stocks that you are anticipating will grow considerably over a certain period of time. GRAT's time period usually is, it can be anywhere from 2 years all the way up to 10 years, depending on market conditions, depending on the type of assets. You receive an annuity annually. At the end of the day, you're actually receiving the value of the trust initial funding value back. So it's the accumulated growth in the asset that you are transferring out of your estate. And it has to be done carefully. We take care and manage GRATs in our department. We work closely with the attorney who's drafting the trust. So we do have that expertise, and it is a good vehicle, again, to move growth of an asset or assets out of your estate. The second part is a lot of times there are issues with estates, especially with business owners. They do not have enough liquidity. Someone passes, there's not enough liquidity in an estate. So what are your options? What can you do? The Irrevocable Life Insurance Trust, otherwise known as the ILIT, is twofold. It can play two important roles. One, if someone owns a lot of life insurance, when that person dies, that life insurance is taxable for estate tax purposes, federal estate tax purposes. You can open up an irrevocable life insurance trust, have one drafted, have an account opened, and you would transfer those policies. The owner and the beneficiary of those policies change from the individual to the trust name. And you would name a trustee who would be the owner of it, in essence, because they're in control of it. That will remove all of that life insurance from your federal estate taxable estate. So it's a great vehicle to do that if you have a lot of life insurance. Aside from that, it also can be used for liquidity in your estate. The trust can either lend funds to the estate or purchase estate assets, giving liquidity to the estate in order to pay estate expenses and estate taxes. Freezing the estate with intra-family loans, that's also something that can be done if the estate, again, a great example is when you have a business owner or a lot of real estate in an estate. You don't have a lot of liquidity. Intrafamily loans are at a much lower interest rate than a regular personal loan or commercial loan. So sometimes if someone in the family can lend the funds and be able to help the estate with expenses in the meantime, sometimes that is an option depending on the dynamics of the family. The Section 6166 deferral. If someone passes that owns more than 35% in a closely held business, they also have to own at least 20% of the business. But 35% or more of the estate owns a closely held business. The executor of your estate can make an election to defer the federal estate tax payment. You will pay interest at a lower rate, but you can defer it to 5 years out to make your first installment payment, and it can go all the way out to 14 years. So that's something that the IRS does offer to those individuals who pass that have a closely held business and the estate is made up of 35% or more of the assets. The last item are buy-sell agreements. And as most of you probably may already know, it's very important to have a buy-sell agreement when you have a business interest or if you own a business. It will list everything in addition to your operating agreement, your bylaws. It's very important to have in place, especially as not only liquidity for your estate, but as an estate planning document. Because what it does is it will dictate if someone passes, the shareholder that passes, will the company be able to buy that individual's share? Or can the other shareholders purchase that individual's share in the business? So it will dictate that. How it creates liquidity is that there is usually life insurance in place on all of the shareholders. So when someone does pass, that life insurance that the company owns on that decedent's life will be a benefit that will be collected. And that can also help with the estate expenses. So there's a lot more detail that goes into all of these different vehicles and options that you can make. But the important thing I want to say is come to us and ask us questions. We will meet with you. We will meet with you before you go to your attorney and talk to them about what you think you may want to establish, whether it's a SLAT or a qualified personal residence trust. We will meet with you. If you have your estate documents drafted, we will review them and give you our thoughts with the follow-up that you go to your attorney, because we do not provide legal advice. And just to make sure your documents are up to date, a lot of times I experience individuals, they say, well, my estate plan's all set. I did my will about 10 years ago. There has been so many changes, I cannot emphasize enough to you. Call us, we'll set up a meeting with you. Everything is confidential. We'll go through everything with you. We work with your attorney. If you don't have an estate attorney, we can give you 3 referrals of attorneys that have that expertise. And it's very important. I care very much about our clients, making sure that their estate plan is in good order. I sleep better at night because I know they're sleeping better at night. So it's very, very important. And now is the time before the sunset of the Tax Cuts and Jobs Act ends on December 31st of 2025. Having said that, I believe we can open up for questions.
Rosalie, thank you so much. Brandon and Chris, exceptional job presenting on this important topic. I'm just going to put up the contact information slide as I speak. Thank you again for, we had a little bit of a delayed start, for hanging in there. It looks like we retained most of the folks that joined us today, so that's great. And then for those that did have to hop off, we do have a recording that's going to be made available and a follow-up email. So look for that email with the recording. You can share with friends and family, or if you weren't able to stay on for the whole thing, obviously you'll get that in your email. And with that, what we'll do is we'll conclude. There will be a brief 5-question survey as soon as I hit end. So if you can take 2 minutes and give us some feedback. In addition, on the survey, there's a question if you'd like somebody from our organization, from Wealth Management, to contact you. That's a great opportunity for you to let us know that you want to contact, and we'll have somebody reach out to you directly. So thank you again for spending a portion of your day with us, and we hope you have a great rest of your week. Take care.
Thank you, everyone.
Thank you.